So, have you heard that you can hire your children in your business and have it be a tax write off to the business plus tax free income to your children? The truth is, you can. But there are a few common mistakes you're going to want to be aware of if you're doing this strategy for yourself and your business. And in today's video, we're going to go through what that looks like, how exactly to put it in practice, and also, if you listen to the end, a few things to be aware of or tips or tricks if you're in an S Corp or C Corp status. Hi, I'm John Norbert, and welcome to the Financial Prof series. Alright, so what does it actually look like to hire your children in your business? Well, first of all, yes, this is legitimate. I have clients who do this all the time and save money both for their business and make it tax-free income to their children. That's the beauty of it, right? So essentially what happens is the salary or hourly rate that you pay to your children is deductible to the business, right? It's a payroll expense. And on the child's side, as long as you keep it under a certain amount, which here in 2025, that amount is $15,000 per child. That's the individual filer limit. In other words, if you pay them up to that amount, they can deduct it off their taxes and not have to pay anything to the federal government. This is the beauty of it, right? Because your business gets a write-off and your child gets tax-free income. It's a wonderful way to save for college, too. If you want to be able to pay your children, teach them the value of the business that you're building, the legacy that maybe perhaps one day you hope to leave to them, and also help them save for their own education or future if they decide to do another business, and then they can use their money, this seed money that you're paying them, to help form their own business. Anyway, so how do you do it? Well, there are a couple of key pieces, right? First things first, you're going to want to make sure to document everything. So to start off, probably a good idea to have an employment agreement or an offer letter or something of that nature. Think about this like hiring a regular employee. You're going to live and die by your documentation, right? The idea is that if you come before the IRS in an audit, you need to be able to sit before that audit agent with a straight face and say, yes, this is a legitimate business expense because X, Y, and Z. You know, I have this employment agreement with my child. Might sound silly, but it really will help. I have a timesheet that says they were here for these hours. I have a description of duties from the job description that says they're responsible for, again, X, Y, and Z duties. Now, obviously, you're not going to be able to hire your 2-year-old to do IT services. You know, if you have a teenager or two, great. Maybe they're computer savvy and they can, and that's a perfect example. But the younger the child, obviously, the simpler the duties. In it, for instance, you could have your 6 or 7-year-old perhaps taking out the trash or helping out with sweeping the floors, things of that nature. Or if you have a younger child, maybe something as simple as marketing. Do you use their picture in website promotions, things of that nature? Probably a good idea to check with your CPA as well and get their 2 cents on it just to make sure that this is something that would be legitimate. But again, think about it like if you would hire a non-family member to do this same sort of job and pay them a similar rate. If the answer is yes, then as a rule of thumb, that it's probably more likely than not going to be easier to defend to the IRS, right? So again, first mistake that I see is people don't document any of that stuff. Second mistake that I see is that, and we kind of touched on this in number 1, assigning the reasonable duties. So for example, the mistake would be, I want to get that full $15,000 deduction, but I pay my kid for 1 hour of work one day to come and dust the office. The IRS is not going to allow you, most likely, to pay $15,000 when you can get a local cleaning company at $25 an hour. It doesn't make a whole lot of sense to do it like that, unless you want to get into trouble, right? So again, assign reasonable duties and pay a competitive/reasonable rate of pay for what you're having your children do, whatever that may be. And then finally, you want to make sure that when you're paying them, you're doing so in the right way. So not only are you paying them reasonably, like we just touched on, mistake number 2 is not doing so, but also paying them in the right way. So this is where we're going to talk a little bit about what that looks like, right? So if you pay them, generally speaking, it's best to run it through your payroll software. You can either send them a W-2 or a 1099 NEC. This is going to provide, again, some further documentation. Going back to mistake number 1 is document everything, and that documentation is going to be useful not only for the IRS, but also for your CPA who's filing your taxes. And also, it's going to be how you document and pay taxes on that pay if you are an S Corp or a C Corp, right? Now here's where we get into that S Corp, C Corp thing, right? Because if you're a disregarded entity like a sole proprietorship or single member LLC, you can just pay that money straight to your child, and if they're under 18, you don't have to worry about payroll taxes at all, right? It's beautiful. But if you're an S Corp, like we are here at Norberg Wealth Management, there's another layer to worry about because you're still going to, no matter the child's age, have to pay them, or rather have to pay payroll taxes on the amount that you're giving them. So that is where I've seen another strategy come into play. And really there are three ways to go about this, right? Number one is quite simple. Strategy number one, just keep it as simple as possible and pay those payroll taxes. You're still likely going to end up in the positive when it comes to the tax benefit because again, it's a deduction to the business and tax-free income to the child. Option number two, or strategy number two, right? This is where you can pay them through another business that you have. Say for instance, you own a homestead and maybe you have a business where you're selling eggs or farm products through that farm stand or through local farmers markets, and that's a separate LLC, and maybe it's a disregarded entity, like I said, maybe a sole proprietorship or something like that. Rather than paying them through your business, have them perform similar duties that would be useful to that other business and pay them through that secondary business that hopefully is a disregarded entity so that you don't have to pay those payroll taxes, right? And this plays into the third strategy, which is if you don't have another business that's a disregarded entity, again, sole proprietorship, certain types of partnerships, single member LLCs, this would be where you can form a family management company or FMC and use that as the vehicle by which the child gets paid. So the way it would work is like this. You form the family management company, right? And then your S Corp or C Corp pays that family management company a fee for services rendered by the child, and the child is actually paid by the family management company. Because the child is paid by the family management company, no payroll taxes need apply, since it's, again, a disregarded entity and we've formed it specifically for that purpose, just like we would have if we had, again, another company that was a disregarded entity, correct? And then the S Corp, because it's just simply making a payment for services to that family management company, can still take that same deduction on the business side, and that child gets all of that income completely tax-free at the end of the year. Now, the beauty of this strategy, which we've talked about in another video, is that this also gives the child eligibility for income to pay into, say, for instance, a Roth IRA. Remember, Roth IRAs, typically you can take out money for certain common expenses like not only a first-time home purchase, but also education. In both cases, you don't have to be 59 and a half to do so. So if you're looking at using this as an educational savings vehicle that can also play into a retirement vehicle that the child can put their earnings into, it works really well. Oh, and by the way, that same $15,000 or however much you decide to pay them, in addition to counting as income for that Roth IRA, can also count as income to contribute to the company 401k plan. So that child, off of that same set of income, can also contribute to the company 401k plan. So we've talked about this in another video. We might do another video on it again in the near future on how to truly maximize this strategy for your child's benefit. But in the meantime, as long as you're doing those things, you're going to have a pretty good chance of not only being able to get through an audit okay without getting dinged by the IRS on this point, but also of making sure that even if you're an S Corp or a C Corp, again, you follow those tips, you should have an ability to pay your child without having to necessarily incur those payroll taxes that would otherwise come into play. So if you're interested in working with us to figure out if and how you might be able to put a strategy like this to work for yourself and your family and your business, then drop us a line. Give us a subscribe and a like on YouTube here in the meantime so you don't miss another video, and I'll see you out there.